Conversation forward. Ashutosh Bhargava, fund manager and head of equity research at Nippon India Mutual Fund, is with us on this leg of the show. Ashutosh, thanks. Always good to have you on our show. So tell us, we're almost at the end of the earnings season. Before we get to your preferences, tell us if something really stood out for you, an outlier trend, an outlier set of numbers, where perhaps, it's given you more food for thought and maybe even action in the coming weeks in terms of stock selection.
So good morning, Survi. This earnings season has been slightly better than the previous two seasons. Last two seasons, we saw more of a downward trend in terms of upgrades versus downgrades. This time it has been more balanced. Having said that, the stark difference between the consumer companies' earnings versus capex-oriented companies, I think I have never seen this kind of stark dispersion where consumer companies in general have seen bad quarter. And within that, the entry level consumption item, low income, low ticket consumption item, results have been poor, wherein the high ticket consumption or more higher end discretionary consumption trend has been much better. But this kind of difference in in consumption versus capex looks like we are looking at earnings for two different economies, wherein capex side, the corporate side, that expansion continues, results have been good, pricing power is there, and consumption is a big drag on an overall basis.
You actually, I think, brought us to the big debate. And today, one stock, for instance, Page Industries, is really highlighting that debate, right? What exactly is happening with the consumer? So some more color on this will really help. One trend is that the premium end of consumption or consumer offerings, the premium end is doing better than the entry level. But what else stands out for you? Anything else that you can add to this in terms of what part of consumer is growing? What part looks really concerning?
So if you go back to, it's all related to, pre-COVID era consumption overall was weak. But after COVID, we saw this K-shaped recovery wherein the low-end consumers, I would say almost 75 to 80% of the household were impacted because of COVID in some way or the other. There has, post reopening, there was some recovery, but a big part of the consumer segment has been impacted by two things. One is inflation, and the second one is interest rates. So very importantly, whatever interest rates hike we have seen, 250 basis point rate hike by the RBI in last 1 year, it has impacted consumer more than the corporates, because last 10, 11 years, whatever incremental lending growth that has happened in this country, consumer loan has been at the forefront. So in our calculation, last 11 years, household debt has gone up by more than 4x. And when interest rates rises, they are the ones who are having that kind of pinch. So higher EMIs and higher inflation at a time when low end of the consumers have to repair the balance sheet. I think both the lower end as well as I would say, a big part of the middle class India, I think, is in a slightly weak spot versus higher end consumers, which did not have income or a wealth problem, balance sheet problem. They are in fact in a better shape when interest rates have gone up. In fact, it improves their balance sheet situation. So their sentiment remains good, as you can see in hotels or SUV sales or travel stocks. All over, this dispersion is visible.
Ashutosh, morning. Capital goods is a theme that you like, clearly. The numbers have been strong. The order book has been good. The management commentary is upbeat. And maybe these companies are in a long-term upcycle. But how comfortable are you with the valuations at current levels? Some of them are trading at 30 times, some going up to 50 times as well, forward multiple. Are you comfortable with these valuations? Because they are higher than the 10-year average multiples. And how would you look at valuations over this upcycle of capital goods companies?
So there's no argument about the stocks have run up a lot, valuations have gone up a lot. And it has been very broad-based. I think we have perhaps not seen this kind of broad-based standout bull market in all size category, large cap, small cap, all kind of capital goods stock, industrial stocks have done well. But as an investor, our problem is, always about if we don't like something, what is the next best alternative? There, if you look at the consumer segment, for example, the choices between buying a very expensive consumer stock versus a capex stock. The advantage with capital good or capex-oriented companies is that the balance sheet, as you said, is great. Order books have been very strong, so you have those earning visibility of next many quarters. The margins have been improving and can further improve given the commodity price trend and the operating leverage these companies will get. So on a relative basis, even after the run-up, as an investor, we don't have much choice but to remain invested. That has worked for us, and we won't be in a hurry to, shift it back to something else.
Okay. Speaking of pockets which have already run up, do you have a view on the defense stocks, on railway, on hotels? Because these are pockets of the market which have already seen quite a run up. But do you think we're set for much more from here in terms of the kind of stock moves we could see?
In terms of earnings, I think the positive trend will continue for some more time. But you are right, at some point of time, we have to start reducing the weights. Some of these segments we have been overweight, and that has helped us. So, selectively we are booking profits. But as I said, the biggest problem for investors today is the reinvestment risk. Where will you go if you book profit from something which is working? Because the dispersion in the market is very stark, as I mentioned at the beginning, that to go to the next best alternative, that next best alternative is not really attractive at this point of time. So we would be booking profits in some of these segments, but very gradually, to be honest.
Okay, all right, Ashutosh, we'll leave it on that note. Thank you for joining in. Very interesting thoughts there, and we need to watch this, I think, this consumer space very carefully to see what sort of comes up in the next few months. Quick break on that note. On the other